Hello, Luke Stein here. This short video is going to introduce some of the key tools for completing long-term financial forecasts. I hope that all the topics that we're covering in the course feel practical, but this is going to be one where even though there'll be a little bit of theory introduced now, it's going to be very hard to make progress on financial forecasting without really just practicing. So this video will be short. It's mainly going to introduce some of the concepts that underlie our development of long-term financial forecasts. But then a lot of the learning will really happen as we start to practice building forecasts. So we can think about firms as developing forecasts in order to make sure that they are able to meet their future financing requirements. To that end, they of course have to figure out how much financing they're likely to need and what they currently have. And then to the degree that there's a difference between needs and financing available, they're going to have to figure out how either to meet those needs or to adjust their strategy in a way that eliminates the need to raise additional financing. So we'll think about financial forecasting and financial planning as generally falling into either long-term or short-term financial forecasting. And while this slide will focus on introducing the differences between them, most of the work we're going to do on financial forecasting will really be focused on the development of long-term financial forecasts. Typically, firms will engage in long-term financial forecasting over a 3 to 5 year horizon, often focused on annual forecasts, sometimes quarterly, but often annual, of the income statement, the balance sheet, and to the degree that these forecasts are going to drive firm valuation models, the free cash flows of the firm, where of course basically all the lines we'll need in order to estimate free cash flows will appear on the income statement and the balance sheet forecast. Why 3 to 5 years? Well, meeting long-term financing requirements is often going to require the firm to take large-scale actions like issuing new capital, taking out large loans, adjusting dividend policy. And so those things can take a long time to actually enact changes on. So the firm needs to have a long-term financial plan that goes out far enough that they know what to expect over that horizon. For certain firms and industries, even longer-term planning can be useful and sometimes gets done, especially in firms or industries that are very, very heavily reliant on either extremely long-term capital investment projects or rely heavily on R&D or other project investments that are likely to have very long payoffs. But many firms don't actually extend their planning horizon quite that far, in part because beyond about 5 years, it can be very, very difficult to anticipate what the economic and business environment are likely to be that the firm will be operating in. In contrast, short-term financial plans often only go out approximately 1 year and are typically conducted at a higher frequency. So these short-term forecasts, which are largely focused usually on the cash flow statement for the firm, may operate at a monthly, a weekly, or even, especially for the shortest term, forecast term, a daily frequency. And you can imagine, businesses need to make sure that they have cash on hand. They have to have money in the registers in order to make change. They have to have cash on the days that they're going to make payroll to make sure that the checks don't bounce. If they have tax payments due, they have to make sure they actually have the money in the bank on the day that they're planning on making those transfers. So depending on exactly how cash sensitive a business is, they may forecast at extremely high frequencies. Underlying both of these processes, of course, is a larger strategic planning apparatus. And so as we get into talking about how we'll develop financial plans, you'll see that it's going to rely on understanding something about what demand for the firm's products is likely to be, what kinds of products they're likely to launch, what kinds of costs they're likely to incur in order to develop, produce, and sell those products. And so really the financial planning process needs to happen hand in hand with a deeper set of strategic plans, and they're going to inform each other. So not only is the firm's strategy going to help determine what their finances are likely to look like, but the availability of financing in the future is likely to help determine and perhaps constrain what strategic directions the firm can go in. They can only grow as fast as they have financing available, for example, to support that growth. So I'm going to describe a 3-step recipe for developing a long-term financial plan. This is not the recipe, this is a recipe. There are other ways to do long-term financial planning, but this is one of the most popular and the one that we're going to talk about. It's sometimes called a sales-driven or a revenue-driven forecast. There's 3 steps in the recipe. The first step involves forecasting sales. The implicit assumption that underlies a desire to start our financial forecast with a sales forecast is that sales drive other financials. So we're going to have to adjust And we're going to have to think about the relationship between the strategic plan and all of the lines that we're going to forecast on various financial statements. But we're going to start with sales because our implicit assumption is if you sell more, you probably, all else equal, need more assets to support those sales. You're probably going to incur more costs of various kinds to support those sales. You may, in fact, be able to or have to borrow additional liabilities. And the profitability of the firm, which is ultimately driven by the amount that it sells and the profit that those sales kick off, is going to determine the amount of capital that the firm has on the equity side. Obviously, some of that has to do with how many shares they sell or buy back, but a big part of that, especially for firms that are either earning significant profits or earning significant losses, a big determinant of how much equity they have on their books is going to be the degree to which they're able to reinvest profits in growing the firm, or that they need to spend down paid-in capital, which is especially common for early-stage firms that are losing money. So step one is going to be to prepare a sales forecast. The second step of our long-term financial planning recipe is going to be to prepare what are called pro forma financial statements. And a pro forma basically just means sort of a first draft approximation. Pro forma literally means for the form in Latin. And so at this stage, we're not necessarily preparing yet what we would actually consider a forecast. We're sort of filling out the form and preparing that first draft. Then in step three, we're going to use those pro formas to figure out how much financing the firm needs and how much financing the firm has available. And to the degree that there is a need in excess of financing available, we need to figure out how the firm is going to seek to meet those additional financing needs. And not to give away where step two leads into step three, but the reason that we're going to need to adjust the pro formas typically in step three is that when we forecast assets, liabilities, and equity on the balance sheet in particular, as we will in step two, there's no particular guarantee that the balance sheet will balance, that assets will equal liabilities plus equity. And to the degree that our pro forma balance sheet forecast doesn't actually balance, that's going to relate to the fact that the firm either needs to raise additional financing if our asset forecast is larger than our liability plus equity forecasts, or has excess financing available if the asset forecast is below the liability plus equity forecasts, in which case the financing needs we would sometimes refer to as being negative. So step one, construct a sales forecast. This is the first step in the sales-driven long-term financial planning process. How are we going to develop a sales forecast? Well, really, that's not strictly a question for a finance person. And that's really going to be the place where this financial planning process connects most closely with the strategic planning process. Generally, the way we would think about starting a sales forecast would be for an existing firm to think about what its past sales trends would be. So all else equal, a firm which has grown sales at a relatively constant rate of 3% per year, we might start by forecasting that sales are going to continue to grow at about 3% per year. And then typically we would adjust those past sales trends based on factors related to the strategic plan that would lead us to expect that the firm could, over the planning horizon, grow sales either faster or slower than it has historically. Obviously, this is going to be more challenging for firms that are new or startups, where past sales trends are less likely to be indicative of what will happen in the future. And in those cases, we're even more likely to rely not only on the firm that we're forecasting's past sales trends, but also to think about the growth of the industry they're in, the competitive dynamics of the industry they're in, and indeed the growth of the economy as a whole. So you can think about this as happening either in a kind of top-down way, which is what I've just sort of described more, but also with contributions from a sort of a bottoms-up analysis. How many units do we think the firm is likely to sell? And that might be based on market research. And what kind of pricing do we think that they might be able to charge? So suppose we've developed our sales forecast going out for the length of the planning horizon, say 3 to 5 years. We have an idea what we think sales are likely to be each of those 3 to 5 years. So the second step of our long-term financial planning process is going to involve preparing those first draft or pro forma financial statements. Use reasonable assumptions. What's a reasonable assumption? Well, unfortunately, it depends. So that's why financial planning really turns out to be more of an art than a science. One of our most common tools, and something that we would, consider perhaps a reasonable baseline to start from before we try to rely on knowledge and expertise that we have about the firm's specific strategic plan, is to use a method called the percent of sales method. So what does the percent of sales method mean? it assumes that various accounts in the financial statement grow at the same rate as sales. So all else equal, if we think that sales are going to grow by 3% next year, maybe we think that COGS, cost of goods sold, are also going to grow at 3% next year. If you sell 3% more, maybe you're going to have to spend 3% more to produce that stuff. And if COGS grow at the same rate as sales, that means COGS remain constant as a percent of sales. Another way of saying that same thing would be that the firm's gross margin it remains constant. So to the degree that various expense lines grow at the same rate as sales do or remain constant as a percent of sales, we can think about that representing constant margins of various kinds. We're also often going to use the percent of sales method to forecast various kinds of assets. And the idea there is very similar. If you sell more, maybe you're going to have more inventory, because inventory is stuff that you have on the books waiting to sell. If you're going to sell more, you have to keep more inventory around. Accounts receivable would be another example of an asset we're likely to forecast using the percent of sales method. How do you generate accounts receivable? 2 steps. First, you sell stuff, and then you don't get paid for it. If you sell more stuff, assuming you get paid at the same rate, if you sell 3% more stuff, you're probably going to have about 3% more AR. So in the same way that growing expenses using the percent of sales method is equivalent to assuming constant margins, growing assets as a percent of sales is likely to represent having constant turnover ratios, inventory turns or AR turns. We're going to grow some liabilities as a baseline, assuming the percent of sales method. And the liabilities that we are going to assume remain constant as a percent of sales are ones that we sometimes call spontaneous financing sources, where the 2 key ones are accounts payable and accrued expenses. So if the firm sells 3% more, maybe it's reasonable to assume that they're going to have 3% more accounts payable. The idea being, how do you generate an AP? Well, you purchase something that will ultimately be an input to your production process from a supplier, and then you don't pay them. If you're selling more, you're probably buying more. And if you're buying more and paying at the same rate, you're going to have more accounts payable. The same argument would hold for accrued expenses. So if we use the percent of sales method, we're going to assume that that many or perhaps even all asset accounts grow at the same rate as sales and therefore remain constant as a percent of sales, that some liabilities, in particular, liabilities that we would expect to grow spontaneously through the firm's operations as sales grow, in particular AP and AE, are also going to grow at the same rate as revenues. And then as a baseline, we might assume that every operating expense line for the firm is going to grow constant as a percent of sales. So operating expenses like COGS and perhaps SG&A, we can forecast this way to the degree that property, plant, and equipment is forecast using the percent of sales method and the depreciation rate remains constant. We might also forecast D&A, depreciation, and amortization using the percent of sales method. As we work towards the bottom of the balance sheet, this becomes the income statement, rather. As we work towards the bottom of the income statement, this becomes a little bit more suspect. Is the firm's interest expense, for example, going to grow with a percent of sales? Less clear that it will. The trickiest thing typically to forecast on the balance sheet when we're completing these pro formas is going to be retained earnings. So the way we'll typically do this is by thinking about the amount of retained earnings that the firm will have each year on its balance sheet at the end of the year as being the amount of retained earnings that they had at the beginning of the year plus some change. And what's the change? Well, firms change their retained earnings by reinvesting profits in the firm. So when a firm earns profits, earnings, net income, 3 names for the same thing. When a firm earns profit or earnings or net income, it can do one of 2 things with that. Either it can pay it out as dividends to shareholders today, or it can reinvest that profit in the firm in order to try to increase the value for equity holders at some time in the future. And so if we know how much net income we think the firm is likely to earn, and that's going to come straight off of our income statement forecast, which we've described something about how to do using the percent of sales method. So if we can rely on our income statement forecast to think about how much net income the firm is going to earn in each year of our forecast period, and then we're prepared to make some assumption about the amount of dividends that the firm is likely to pay in that year, whatever's left, net income minus dividends, has to be the amount that the firm reinvests in retained earnings. And that will allow us, with a net income forecast from the income statement and some assumption about dividend policy, to forecast the change in retained earnings and therefore the level of retained earnings at the end of each period over the course of our forecast. So step 3, let's take those pro forma financial statements and let's try to figure out if the firm needs any additional financing and how the firm might meet it. So we'll take our pro formas, and in particular, we'll take our pro forma balance sheet, although, of course, the pro forma balance sheet is going to be based on, in part, on things that come off of the pro forma income statement, in particular, through that calculation of retained earnings that I described on the last slide. We're going to take that pro forma balance sheet and we're going to think about all of the ways that the firm is going to use its financing that's available to it. How does a firm use its financing? It uses financing in order to buy assets. So the firm has current assets like cash, accounts receivable, inventory, etc. It has long-term assets like property, plant, and equipment. All of those things have to have been bought, and they're recorded on the balance sheet at some adjusted version of the price that the firm paid for them. So that asset forecast is, the amount that the firm needs in order to support the revenue that we think that they're going to generate from step 1 in the sales-driven forecasting process. Where does the firm get financing in order to buy those assets? Well, it comes from 2 sources. It comes from liabilities, both the liabilities that it had last period and the liabilities that grew spontaneously, and all of the equity that shareholders have in the firm, which is the equity they had at the beginning of the year, plus any increase or decrease in equity through reinvestment. And I say decrease because a firm that loses money may actually need to spend down its retained earnings. So when we said on the last slide that new retained earnings equals old retained earnings plus reinvestment, and reinvestment is net income minus dividends, if the firm was losing money and net income was negative, they're going to be decreasing the amount of retained earnings in the firm. Actually, a profitable firm, one that has positive net income, can also be drawing down retained earnings through negative reinvestment if dividend payments are larger than net income. And some boards and senior management don't like to pay dividends in excess of net income, but sometimes firms are willing to do that. Okay, so we've figured out how much we think the firm is going to use. That's our asset forecast. We've figured out how much the firm is likely to have available to it to buy that stuff, either in the form of liability and equity finance. And then we're going to compare those two and try to figure out, does the firm have additional financing needs, sometimes also called discretionary financing needs? So where do those needs come from? What's the problem? Well, I've already alluded to this earlier. The issue comes if the assets are the asset forecast is in excess of the liability plus equity forecast. And this is a very, very common problem that firms, especially startups, smaller growing firms, frequently face. So what's the problem for those firms? Well, firms that are growing rapidly need to grow assets rapidly in order to be able to sell more. If you're going to sell more, and firms that are trying to grow quickly want to sell more, they're going to need a lot more assets typically in order to do that. What about liabilities? Well, firms that are growing fast may have some slow increase in liabilities. Maybe they're able to get a little bit more from their suppliers through accounts payable. Maybe they're able to get a little bit more from, say, their employees who only get paid every other week or once a month and therefore owe a little bit of money to the firm because they work for a week or 2 or 3 or 4 before they get paid. But unless the firm goes to the bank and borrows more or goes to the investment bankers and issues new bonds, liabilities are typically going to increase only slowly, if at all. What about on the equity side? Well, equity only increases if the firm issues shares, which it only does in consultation, say, with a bank and through an active decision. But in terms of a spontaneous increase in equity, we just can think about the amount that it's reinvesting in retained earnings. And to the degree that the firm is either paying out all of its profits as dividends, or, as is more common for startup firms, actually not earning profits at all and losing money, as many small and growing firms do, equity is likely to be staying the same or perhaps even changing. So the firm goes into every period with an actual balance sheet that balances. Balance sheets have to balance. So the firm's assets are equal to its liabilities plus its equity. And then our forecast, given the firm's strategic plan, is often that equity is going to increase by perhaps a whole lot, whereas, that assets are going to increase perhaps by a whole lot, while liability increases only a little, if at all, and equity often, in fact, decreases. And so the gap between forecast assets and forecast liabilities plus equity is going to represent that AFN, or additional financing needed. And so having developed the forecast, we can measure the size of that AFN And then the picture on the right-hand side there suggests the kind of options that the firm faces. In fact, it has three and only three options for trying to meet that additional financing needed. Option one is the firm can try to reduce the amount of assets that it's forecast to have. And it can do that either by growing more slowly than our forecast. Hey, we'd really like to launch 17 new stores next year, but we don't think we're going to have enough money to get them off the ground, so we can only launch 15 instead. Yeah, revenue is going to grow a little slower than we forecast, but we have to revise that sales growth forecast down in order to meet our additional financing needed. So one way to do this is through reduced assets. And that reduced asset need could come, as I just described, through lower revenue growth, but it could also potentially come through operational efficiencies. So a firm that figures out how to manage its supplies in a way, for example, that maybe they can get away with less inventory, or if they were perhaps to run, let's say, a third shift on their manufacturing equipment, they might be able to sell more stuff even without increasing assets as fast as revenue grows. So the first would be adjusting the sales growth rate from step one of the forecast, and the second would be adjusting the pro forma with a divergence from the percent of sales method and trying to forecast through operational improvements asset growth slower than sales growth. The second possibility is that rather than lowering the asset side, the firm could try to increase the amount of liabilities that it has in order to meet that AFN. Some of that could come through operational changes. So the firm might try to do things like pay its suppliers more slowly in order to generate more accounts payable. But typically the way that a firm would increase its liabilities would be by borrowing. So that would be either going to the bank and taking out loans or working with an investment bank in order to issue new bonds or debt. The third thing the firm can do is it can try to increase the amount of equity that it has on its books. And how can it do that? Well, in order to increase equity, the firm can either become more profitable. So if it has more profits, perhaps through operational improvements, cost cutting, if the firm is more profitable, then it has more money to reinvest in the firm and can increase paid-in capital. Even at a constant level of profitability, the firm could increase equity by lowering its dividend payouts. So if the firm pays smaller dividends, they're going to have more money left to reinvest in retained earnings for the firm. The other possibility is that the firm could issue new shares. So the firm could work with an investment banker in order to sell new shares to the public. And that's what a firm needs to do to meet its AFN. Now, sometimes a firm will have a negative AFN, a negative additional funds needed, would mean that it has excess funds. So the asset forecast is below the liability plus equity forecasts. And that means that the firm has excess funding available, and it can do the opposite of any of those things I described. Now, typically, a firm that had excess financing would not want to say, oh, let's make our operations worse. But they could certainly do things like pay back some of their debt and reduce their liabilities that way. Or they could choose to pay bigger dividends or buy back shares, which would reduce their equity in either case. They could also seek just to raise assets more, perhaps by growing faster. So suppose the firm decides how to adjust its strategic plan in order to meet those that additional financing need. So it does things either like adjust its operations, or it actually goes and raises money either by issuing notes payable, that's borrowing short term, by borrowing long term through a bond issue or taking out a bank loan, long-term debt, or by issuing common stock, or by increasing paid-in capital through common stock by reducing dividend payouts. All those things require managerial discretion to do, and so we call all of those things discretionary sources of financing. So, the key distinction there is between what we called earlier spontaneous sources of financing. In step two, we called spontaneous sources of financing. So the spontaneous sources of financing were the ones that increased on the liability side automatically, just through growth in the firm's operations. The discretionary financing sources are the ones where management is going to have to make some decision. Depending what sources of discretionary financing the firm chooses to rely on, that's going to affect the firm. And in particular, it's going to affect the firm's weighted average cost of capital, and therefore perhaps the projects that the firm chooses to engage in. Because we know that the WACC affects the IRR hurdle, the NPV calculation for various projects that the firm is considering. And those impacts are actually two different kinds. So one is a firm which chooses one source of discretionary financing source rather than another, say that borrows debt rather than issues stock. Well, that's going to change the firm's capital structure. And we know that a firm's weighted average cost of capital is the weighted average of the cost of different sources of capital. And so to the degree that they rely more on cheap sources of capital, that could lower their WACC. To the degree that they rely more on expensive sources of capital, that could raise their WACC. The other thing, though, is that the choice of financing source also affects the level of risk in the firm. So a firm, for example, which has borrowed a whole lot of debt, the lenders may get nervous about whether the firm is actually going to be able to meet all of those debt payments, and therefore may require the firm to pay higher rates of interest or higher yields on its bonds as compensation. And the same firm, if it borrows more, shareholders may get nervous. Hey, we only get profits after interest payments get made. If the firm borrows too much, it's really risky. Like one bad quarter or one bad year, the firm may have trouble paying back those loans, and we're going to be wiped out. So what we just described is the degree to which what's sometimes called leverage can make a firm riskier. And so a firm, when it chooses to meet its discretionary financing needs, that includes a choice of the firm's leverage. How much do we want to borrow versus how much do we want to raise from shareholders, which is going to affect both the weights in the WACC and investors' required rates of return through the risk of the firm. So a firm can choose to get discretionary financing source, or they can just grow slower, which may be a safer strategy, but one that investors may or may not like. And of course, if operational improvements are available, they'll often look for those because that is, in a sense, a free lunch, except that it can be really, really hard to achieve.